All right. So I guess one of the first things I'd like to do is just give you a quick update as to what happened last year in the markets. And you may have seen your statement online. I don't think the paper statements have gone out yet, at least I haven't received mine yet. But 2020 was a really interesting year. And what's interesting is that we built a lot of momentum in the market through January and February, kind of coming out some softness in December 2019. And what's interesting is that all of a sudden, this thing called COVID started to raise up. And all of a sudden, there became a lot of uncertainty as to exactly what was this virus, how far was it going to go, how many people was it going to impact. And as a result, the markets don't like uncertainty. So all of a sudden, as we started to see the virus spreading all through Western Europe, all the way over into North America, the stock markets globally, they really started to drop. And what's interesting is a lot of the global indices dropped between 30 to 35%. So it was a fairly significant sell-off. What's interesting, though, is that once we started to understand a little bit more about COVID, all of a sudden we started to see the market starting to get some traction and stop that free fall. And then all of a sudden, as we started to get some positive news of a potential vaccine, we started to see the markets climb. As we started to get vaccines into production, the markets continued to go up. And then once we passed the US election in November, we saw the markets really have a robust recovery towards the end of the year. So when you get your statements, I think you're going to be pleasantly surprised that it actually turned out to be a really solid year. And depending on your risk tolerance, it's something that, like I said, I think you're going to be quite happy. One of the interesting things is that as we move forward to 2021, we're starting to see a lot of positive indicators that are starting to show themselves. And a lot of the analysts and economists are starting to project that 2021 should be another solid year. So fingers crossed, but again, your patience and your faith in the plan last year worked out beautifully. So one of the things that we're going to talk about today is RSPs, tax-free savings accounts, and RRIFs. And I think the RRIF one is the one that I really want to focus on tonight with a lot of you. So we're going to go through that. What's interesting is all three of these accounts are actually quite similar, but yet different. And the interesting thing with it is that they're all what we call registered. And what that means is the government keeps track of money that you put in and take out. So that's something that they want to know exactly what's going on inside that account, because you can only put in so much. They all have rules, and that's something that you're probably all familiar with RSPs. You might be familiar with tax-free savings accounts, but the RRIF piece is something that's relatively new for a lot of the people that are attending today. There's cash, or there's tax consequences, and there's advantages to each. A big question I have with a lot of people is what's better, an RRSP or a tax-free savings account? I'm not going to get into that tonight with you because it's really dependent on a person's personal situation. But if that's something that you want to ask me that question, by all means, please send me an email and I'd be happy to go through it with you. And then the final thing I just want to mention to you is that there's some really good tax planning opportunities for each of these. So tax-free savings accounts. The interesting thing with the tax-free savings accounts is that they started in 2009, and this was brought out by the conservative government. There's annual limits that we can put money into it, and I'll talk about that in a moment. The great thing with the tax-free savings account is it's a wonderful opportunity for you to keep more money in your pockets instead of share it with the government. This is an interesting time of year that as you start to take a look at all of the T-slips that come in the mail, you start looking at doing your taxes in March and April, you start to realize how much tax that you paid in 2020. And if we can keep more of this in your pockets, that's a good thing. Now, one of the challenges I find with the tax-free savings account is, do you actually invest that money or do you save it? Well, it's interesting. There was actually a bunch of studies that have been done, and 42% of people actually leave it in a savings type component. So making somewhere between 0.15% to 0.55%. It's a huge, huge lost opportunity here, because if you can put this money in and let it grow all tax-free, it's a wonderful opportunity that you can use this potentially in retirement to help supplement your income. There's also a wonderful opportunity that you could be drawing some money out for some of those large expenses. And again, not sharing any of that money with the government. So this is something that I really wish that the government would have done things just a little bit differently and actually would have called it a tax-free investment account, not a tax-free savings account, because there's a lot of people, obviously 42%, still keep this in a savings type environment. The interesting thing with the tax-free savings account, like I said, is that there are contribution limits, and I'll get into those in just a moment. But one of the interesting things and what causes a lot of challenges for Canadians is that they put money in, they take money out, and they start to get confused. And that's where it starts to get a little bit sticky. I've put up just a green box on the screen here. And what you can do is you can actually go to the CRA website, and there's a link on there called My Account. If you want the link, by all means, send myself or Jen an email, and we'd be happy to send it to you. But you can actually take a look at the history, how much money you've put in and taken out of your tax-free savings account, so you don't go over contributing. That's something that when you do over contribute, it's something that the government will penalize you for it. The strange thing with the government, or it might not be so strange at all, is the fact that the government is really, really slow to catch this. And I've had clients that have had letters a year or two after it's actually happened, that all of a sudden they get a letter in the mail saying that they've over-contributed to their TFSA. So again, we really want to make sure that you stay in the good books with the government and you don't over-contribute. But essentially, if you put money in, take money out, you can recontribute it, but you have to be really careful how you do that. So when it comes to the tax-free savings account program, like I said, this started in 2009. That first year, you're allowed to put in $5,000, and you can see at the bottom of the chart there, that was the first amount. And that $5,000 amount stayed for the first couple of years, and then it started to climb. The original intention with the contribution amounts was that the government was going to index it with inflation. Well, inflation over the last number of years has really been only about 2%. But then what happened was in 2015, the Conservative government bumped it up quite significantly. Once the Liberals came in 2016, they pulled it back, and then they left it at the $5,500 mark for a couple of years, and then it started to increase again. So what is interesting is that as of 2021, you can have contributions, so money that you've put into it, of up to $75,500. One thing that I would suggest is if it's all possible to really maximize this, and whether you reposition some money in a savings account or a GIC or even just a non-registered account, the more money you can have in here, the better. One thing that I dug up was just 4 common mistakes, and we talked about mistake number 1, just basically holding cash type investments in that account. The second one is actually taking money out to set up another TFSA. And what I would suggest is that if you're looking at setting up a different tax-free savings account, you can actually sign a form to transfer that account to another TFSA. So all of a sudden, it stays in a tax-free savings account, it goes to a tax-free savings account, it stays kind of in that tax-free environment. So all of a sudden, you don't have a problem over contributing. But if you've put money in, you take it out, and then you set up a new tax-free savings account and put that money back in, chances are pretty good that you could over-contribute, which comes to number 3, making sure that you don't over-contribute. Like I said, that's something that you can go to the CRA website. There's a history that you can take a look to find out how much money's gone into it. The one thing that I would say is that if you are a US citizen, you want to steer clear of the tax-free savings account program. It's something that the US doesn't recognize it as a tax shelter, and it can get you in offside with the IRS. Mistake number 4 is actually just not opening up a tax-free savings account at all. So again, there's a couple of tips and tricks there for you. The interesting thing, and actually one of my favorite pieces to the tax-free savings account program, is that we can actually name a beneficiary on this account. So what happens is that if you were to pass away, we could have this money go to somebody directly. And I'll talk more about the estate planning side of this as we get further on into the presentation. But to me, this is absolutely key. What also is interesting is that there's 2 different ways that you can set up that beneficiary. You can have just a regular beneficiary, or you can have a successor holder beneficiary. I really like the successor holder beneficiary designation, because what that means is that the tax-free savings account will roll into your tax-free savings account. So as an example, if you've got $80,000 in your tax-free savings account, your spouse has $80,000 in their tax-free savings account, they were to pass away, now you can take that and roll it all into yours. So instead of it getting paid out in cash to you, it actually rolls into your tax-free savings account. So it's a wonderful opportunity. I can tell you that with all of my clients, this is something that I've automatically done this for you. But if you do have a tax-free savings account outside of the management of myself and Jen at IG, that might be something that you want to take a look at, is to make sure you've got the beneficiary designation set up properly. The other nice thing here is that if something were to happen to you or to your spouse, it goes to the survivor. But then if something happens to both of you, you can also name potentially kids or charities or whomever you'd like to leave this money to. So again, it's very, very efficient, and it doesn't go through the will. It's not probatable. It's really nice and clean. Literally with a copy of an application form and a declaration of transmission, copy of the death certificate, we can literally get this rolled over. So really, really smooth. The next piece is starting to move into RSPs, and this is something that RSPs have been around for a long, long time. In fact, it was 1957 when they were first introduced. The interesting thing with the RRSP program is the government wanted to provide an incentive for people to start saving money for their retirement. What's actually interesting, back in 1957, a lot of people lived into their mid-70s. So you retire at 65, you live to your mid-70s, you had about a 10-year window that you were alive. The challenge now is that people are living into their 80s, 90s, and 100s. So this is something that we want to make sure that you don't outlive your money, and that's why it's important to save for retirement. The nice thing with the RSP program is that when you put the money in, you get a tax deduction on that money. So what that does is hopefully generates a tax refund for you, which again, you can put that into your tax-free savings account, you can put it back into an RSP. If you've got a mortgage or a debt, you can harness it and use it towards one of those items as well. But the big thing is getting more of your money back from the government and getting it back to you. The nice thing too is that when you put that money in and it grows over time, that money grows tax deferred. Now, I'm not going to say tax free, because you do have to pay the tax when the money comes out. But each year that goes by, you don't have to pay the tax on any of that growth. So normally what would happen is that outside of an RSP, outside of a tax-free savings account, let's call it just an investment account, if you earn interest income, dividends, capital gains, you're going to get a T3 or a T5 slip that you're going to have to add on to your income tax return. Inside the RSP program, this is something that all of the money grows tax deferred. Now, like I said, the idea here is that this money grows over time until you retire. And then when you retire, usually your income goes down. So all of a sudden, the real advantage of the RSP is to put the money in when you're in a high tax bracket and take it out when you're in a lower tax bracket. So that to me is really getting the RSP program working at its optimal level. Now, with the RSPs, just like on the tax-free savings accounts, this is something that you can only put in so much money. And when you file your income tax every year, hopefully, you get your notice of assessment when you finish. And the notice of assessment is just a summary of your tax return. It captures some information on there, and some of the information is just shown in the box on the screen here. And what that's showing is the amount of money you can put into your RSP. And I just circled this in blue for you. But this is something that you have a certain amount of money that you can put in. If you've got some back room that you haven't maximized it and you've got some extra money sitting around you don't know what to do with, well, you can always add it to the RSP if you choose to. What's interesting is that your RSP contribution room, the new money that you get for this year, is actually based on last year's income. It's 18% of your last year's earned income starts to create new room for you this year, but this continues to build and grow if you're not maximizing it. And you can continue to put money into it up until you're 71 years old. And we'll talk about what happens at that point too. But again, it's a great program, and it's something that's a great opportunity for us to save more money and keep it in your pockets. 5 big mistakes when it comes to RSPs, actually very similar to the tax-free savings accounts. Again, the first one is investing cash. This is something that we want this money to last and give you an income for the rest of your life. So even if you're 65 or 70 years old, chances are in your financial plan that I've prepared for you, we're estimating your life expectancy to age 90, 95, or 100. So for us, we want to make sure that you're at least keeping pace with inflation, if not growing that account. So again, we want to make sure that we're investing in the right things. The second thing is taking the money out too early. One of the amazing things, and I think Albert Einstein coined this, is the 8th wonder of the world, is compound interest. And what's interesting is that usually the investments start growing quite slowly and then they start picking up. that growth, that compounding effect is extremely powerful at the end of the day. And that's something that we really want to make sure that we maximize that. So again, the money that goes in, if we can leave it in there as long as possible and get that money working and growing for you, that's a good thing. The next thing is taking a look and over-contributing. And I do find for most people, they don't tend to do it. Where it does start to get a little bit challenging is that if you work for an employer and you've got a pension plan. Now, normally when money goes into a pension plan, it actually reduces your RSP limits. Now, where the challenge comes up is that over time, depending on your employer and depending on the pension plan, this is something that it can actually use up all of your RSP room. And if you put in too much money, then all of a sudden you're in the bad books with the government. It starts to create some challenges because they start to penalize you, they start to charge you interest on it, and you've got to pull that money back out. So again, that's something that we have to be very, very careful with it. Mistake number 4, and I talked about this before, is actually spending the refund. You know, a lot of times what I find is that people might get this tax refund. In the old days, maybe you go to Mexico or down to the Caribbean, you have a wonderful holiday, come back with this great tan. All of a sudden, a couple of weeks later, the tan's gone, the money's gone, and you have nothing to show for it except for the memories. Now, don't get me wrong. I think the memories are really important, but it's something that if we can take that tax refund, basically take that money that the government, your money that the government has given back to you, and start to add that back in and really start to work that for you, then we really start to really maximize that benefit. And that's where we get the real power of the RSP. The next one is just not really understanding the succession rules. And I'll talk a little bit more about that one too, but that's really what happens to this money if you were to pass away and goes on to the next generation. So again, 5 mistakes. This is something that you've got me to help make sure that this is something that we keep you on the right side of making sure there aren't any issues there. Now, the interesting thing, and I talked about this before, is that when you go to take money out of an RSP, you have to start paying tax on that money. The challenge is that the government actually tells every financial institution out there how much money they have to withhold. So if you called me up and said, Jamie, I want to take out $5,000 out of my account, we automatically have to withhold 10% tax. It's nothing we can do about it. What happens is that if you ask for $5,000, we withhold 10% or $500. We send $500 to the government, you get $4,500 in your bank account. Now, if you go over $5,000, so basically any amount between $5,001 and $15,000, we withhold 20% tax. So again, you ask for $15,000, I send 2 to the government, I send 3 to the government, put 12 in your bank account, and again, you know, you get the net amount. Over 15,000, you can see it's 30%. Now, this is just a scheduled amount that the government requires us to take out. It actually might be too much, or it might not be enough. So this is something that until we actually take a look at what your income was for the year, add in the RSP withdrawal, calculate what the average tax rate is. Again, this is just an estimate. But what does happen is that when you take that money out of your RSP, you also get a T-slip. So, you know, just like you get a T4 slip when you work, you get a T4A slip for a pension or Canada Pension Plan Old Age Security. Well, in this case, you get a T4 RSP slip. And that just shows the amount of money that came out, the amount that was remitted to the government, and you have to add it onto your taxes. So again, unfortunately, we can't get away from that tax component. One thing that still makes a ton of sense for people is to use a spousal RRSP. And this works in a situation where you've got somebody that's in a higher tax bracket and a spouse in a lower tax bracket. And what this allows you to do is to actually put money, invest money into an RSP into the lower income spouse's name. Now, you might ask and say, well, why would I do that? Well, the nice thing is that that money starts to build in that other person's name, but you still get the tax benefit of it. Where this works out really well is to try to equalize the RSPs in both people's names, in this case, Mary and Bob, as time goes by. Because ideally in retirement, what we want to do is we want to draw the incomes as equally as possible. What's really interesting, back in 2007, the government changed some of the rules around pension splitting. And what's interesting is that if you're taking money out of a RRIF account over the age of 65, we'll talk about this more, you can actually share that income between the two of you. So all of a sudden, where we can use the spousal RRSP is between retirement and age 65. There's an opportunity that we can draw money out in the other person's name. So in this case, we've got Mary as the higher income earner. She's setting up a spousal RRSP in Bob's name. Bob can start to take that money out. The only sticky piece with the spousal RRSP is that there's a 3 calendar year attribution rule. What that means is that if Mary puts money into Bob's spousal RRSP and Bob takes that money out 3 years, within 3 years of that very last contribution. So if that last contribution was in 2020, he can't take it out until 2023. If he does, then all of a sudden that tax gets paid back to Mary. So that's something that we have to be really careful about. But again, it's a wonderful opportunity for us to even out incomes in retirement and try to keep your taxes as low as possible. Now, the next part, this is really, I think, the exciting part, because this is where we get to do some really interesting planning for you. First of all, what is a RRIF and how do they work? We're going to talk about payments. We're going to talk about taxes and frequencies. We're going to talk about the tax slips. And really, what do we do with the money? So what's interesting with the RRIF program is that essentially what happens is that we have to convert the RSP to a RRIF. So it goes from a registered savings plan, and again, you can see on the screen, it's RRSP, RRIF. Again, it's registered retirement savings plan, registered retirement income fund. I'm going to drop one of the R's just for simplicity's sake. But essentially what happens is that at age 71, the government says by the end of the year you turn 71, you have to take that RSP and you have to roll it over from a savings plan into an income plan. So what it means at that point is that you can no longer put money in and get that tax deduction. You have to start taking that money out. And that is part of the challenge here, is that we need to do some forward planning for you to make sure that we can keep you in lower tax brackets. Where the challenge comes up for some people is that they put the money into an RSP at this tax bracket, and all of a sudden, maybe they're taking it out at this tax bracket. So all of a sudden, they haven't really maximized that benefit for them. When we take a look at this, again, it has to be done by the end of the year you turn 71. But what's interesting is that you don't have to take any payments until your 72nd year. So 71, you have to convert it, but you don't have to take any money out. The 72nd year, you do have to start drawing money, whether you like it or not. Now, one of the interesting things with this is that when you got married to your spouse, way back when, if you had the foresight of marrying somebody younger than you, you can actually base your RRIF payment on that younger spouse. And I've got a great chart on the next slide that I'll show you. But again, there's an opportunity there that we can save you some money. Like I said, over the age of 65, so even at 71, 72, we start to draw this money out, we can start sharing it between the two people. So again, a wonderful opportunity. Now, if you're looking at this and saying, you know what, I need the extra money, I need the money to live on, well, then we can set this up as a monthly payment. And what we end up doing is we literally deposit into your bank account on whichever day you like, a lump sum amount, and we can withhold some tax for you. So essentially what we do is we kind of turn the tap on to the RRIF program and start putting money into your bank account, really just recreating a paycheck for you. So again, we can do that on a monthly basis. For some people that maybe don't need all the money, we can do it as a one-time lump sum payment, maybe in December. I don't know about you, but I find December is a pretty expensive month with Christmas coming up. So a lot of my clients will have that payment set up on December 1st. We'll have that go into their bank account. Or what we could do is, again, if you don't need this money, we can actually have it paid into an investment account. We can let it sit there. It has to come out. You have to pay tax on it, but you don't necessarily have to spend it if you don't want to. So again, we've got some flexibility there. Like I was talking about earlier, when you go to take money out of an RRSP, you get a T-slip for that. In this case, you also get a T-slip for money coming out of a RRIF, and it's called a T4RIF. And that's something that at IG, we usually send them out at the end of February of each year. One thing that you can do, and I'm not sure if you've done this or not, but if you've set up for the client account view where you can actually view your statements online, all of your tax documents are going to be on there as well. So that's something that if you don't want to wait for them to show up in the mail, you might be able to get access to them a little bit sooner online. But again, this is something that when you get that T-slip, you've got to add it to your tax return and you've got to claim that as income. What's nice is that the government will always let you take more tax off if you want. You can't take out less, but they can always let you take out more. So what's actually kind of interesting is it's a great opportunity for us to connect, usually April, May, June, once you filed your income tax return, just to kind of see how last year shook out. And we can take a look at that and say, did we take off enough tax or not? If we did, great. If we didn't, then maybe we adjusted a little bit, or maybe, you know what, you're more comfortable keeping the money in your account, letting it continue to grow and not having it sit in the government's pockets, because last time I checked, they don't pay you an awful lot of interest. So again, something to consider. One other thing I was actually just thinking about is on the payment frequency. The other reason, not only because December is an expensive month, but one of the other reasons I like it to come out as a lump sum in December is that we get it to grow for 11 months. So all of a sudden now, we let that money sit and continue to grow for 11 months before we take that money out. So again, that may or may not work for your situation, but the nice thing is that you've got a lot of options. Now, one of the things I'd mentioned to you is that there's a schedule as to how much money you have to take out of a RRIF. I'd also mention too that you don't have to take a payment in that 71st year. You can elect to take that in the 72nd year. And one of the things that I've done is I've put a red box just around the 72nd year on the enclosed table. And what that shows is that in your 72nd year, you have to take out 5.4% of the balance in the account, whether you like it or not. So as an example, if you've got $500,000 in an RRSP account, we've turned it into a RRIF account, at age 72, all of a sudden now you have to take $27,000 whether you like to or not. So that money has to come out. That's not the challenge. The challenge is you also have to pay tax on it. Now, the interesting thing is that if you scroll down and you get to 77 on the bottom and then 78 on the top, one thing you might notice is that those amounts are going up, and they start to go up fairly aggressively as you get into your 80s, 90s, and then once you're 95, you have to take out 25% of the balance, 20% of the balance, whether you like to or not. So this is something, again, we want to do some forward planning to make sure that we keep as much in your pockets as possible. One of the big challenges is that we want to make sure, and we're not talking specifically about this today, but there's something called old age security. Old age security is a pension that you receive for being a resident in Canada for the majority of your adult life since you were 18. The payment is approximately $600 per month. It is taxable. You don't pay into it like you do with Canada Pension Plan. And because you don't pay into it, where I'm going with this is that if you start making too much money, the government starts clawing it back. They start taking it away from you. So again, we want to take a look down the road to try to keep as much of this money in your pockets as possible instead of paying it to the government. The other thing that I touched on was the idea that if you had married a younger spouse, we can actually base your RRIF payments on a younger spouse's age. So as an example, even though you're 72 and we've converted your RRSP to a RRIF, let's say your spouse was 68. Well, all of a sudden now, instead of taking out 5.4% of the balance, at 68, it's 4.5%. So all of a sudden now, there's about 0.85%-ish that you can leave in the account and not draw it out and pay taxes on it. So again, if you had the, like I said earlier, if you had the foresight to marry a younger spouse way back when, it's all going to pay wonderfully for you when you get older. Now, one of the big things that I find a challenge with RSPs and RRIFs is what happens if you pass away. Now, just like a tax-free savings account, we can name a beneficiary on there. And what happens is that there's a tax-free rollover from one spouse to another if something happens to either one of you. You can also name your estate. One of the benefits, and I'll talk a little bit more about that in a moment, but again, one of them is that if you name beneficiaries, that money goes directly to them. If you name it as the estate, then it goes through the will. There's benefits, there's pros and cons to each of those. When the money comes out, the big challenge is that if something happens to both of you, there can be a fairly significant tax bill. And I'll talk a little bit about that too. But you know, one of the interesting things, and I think this is overlooked quite a bit, is that there actually is an opportunity to use life insurance to actually pay that tax bill. Now, I've got some clients that say, Jamie, you know what? The kids are still going to get a bunch of money. Yes, the government's going to get their fair share as well. But you know what? I'm comfortable that the kids are going to get more than I receive from my parents. On the flip side, I've got other clients that say, you know what? I don't want to pay any more money to the government than we have to. And you know, how can we get this as low as possible? Well, what's interesting, and I talked about the beneficiary piece. what most people have it set up as is that if something happens to one spouse, it goes to the other. If something happens to the other spouse, it goes back to the other. But if something happens to both of them, whether on the second passing or in a common disaster, what happens is that money goes into the estate, as you can see on the screen here. And then the estate is actually divided up by the will. So the will is outlined, and hopefully you've got a valid will. If you don't, reach out to me and I'll get you the name of a lawyer and we can have a really good conversation. But your will divides out where this money goes to the beneficiaries. The advantage, and whether it makes sense or not, we have to talk about it, but the advantage of naming beneficiaries on the second person to pass is that money bypasses the estate and the will and goes directly to those individuals. So all of a sudden now, you don't have to worry about probating the will. Now you might say, well, what is probate? Well, what probate is that you have to fill out about a 100-page document. Most people end up hiring a lawyer to do it because it can be a little complicated, but you've got to fill out this document. You've got to take a copy of the will, the original will, to the courts, and then a judge basically reviews it and makes sure that it's legal and it's valid. And once that's done, then they give you some documents that you can go back and you can take care of all of the assets in the estate. Now, the challenge with probate is that in other provinces, such as British Columbia, Ontario, Quebec, it can be tens of thousands of dollars to probate an estate because they take a percentage of the estate. So depending on how much money's in the estate dictates how much probate you have to pay. In Alberta, the maximum fee is $525 for any estate over $250,000. So the cost isn't significant. Where probate starts to become a bit of a challenge is that it takes time. And especially during the COVID times, things have been backed up. So normally it would take 3 to 6 months to get the will probated, and that would be for a basic will. If there were some business interests or some foreign property, it could be significantly longer, but for a basic estate, you're looking at about 3 to 6 months. Before it was probably closer to 3. But again, it takes a little longer to access the monies in the estate and divide it out. The second thing that is kind of interesting, and you might not worry about it, but some people may, is the fact that once you probate a will, all of a sudden that information, your estate, all of a sudden it becomes public record. And somebody can actually go down to the courthouse and get a copy of your estate, your probate documents. Well, what's interesting is that you have to list all of your assets inside that probate document. Well, it was actually kind of interesting. About 15 years ago, my aunt and uncle, they had split up. He was a lawyer in town. She was a teacher. He made lots of money. She made good money. But they got divorced, and he was paying her spousal support. Well, all of a sudden, my aunt received an inheritance, a fairly sizable inheritance. And all of a sudden, the husband, who was a lawyer, went and got a copy of the probate for this person and actually contested the spousal support. So again, this is something that if privacy is really important to you, then we really want to make sure that we keep the probate to an absolute minimum. But again, this is something that we can continue to have some conversations about as to how to structure everything just right for you and what your intentions are. Now, one of the things I was talking about was the taxes on this. And what I did is I just put together a bit of a scenario for you, just a hypothetical scenario of an individual that's receiving some Canada Pension Plan, a little bit of old age security. We've got some interest income. We've got some pension income, maybe from a previous employer. We've got some RRIF income for the year. So their total income, when we add up all of these different pieces, works out to be about $68,000. So they're right in the middle of that middle tax bracket, which is 30.5%, which is between $49,000 and $97,000 worth of income. So again, right where you want to be. The challenge is if that person passes away in that year and they've got $500,000 in their RRIF account, all of a sudden, every single dollar in that RRIF account gets added on into their income for that year. So now, all of a sudden, as their income goes from $68,000 to $568,000 for tax purposes, all of a sudden now there's a $238,000 tax bill. Pretty significant, especially since you've worked long and hard to save this money. We want to keep as much of it in the family as possible. So you might look at this and say, well, Jamie, how do we avoid this? Well, the challenge that comes up is that we don't know how long you're going to live, and we don't know how much money you're going to need down the road. But what we do know is that we might want to start proactively pulling a little bit more money out of the RSPs or the RRIF account early. that we can always reposition it into something else, like a tax-free savings account or a non-registered account. But the less money we have in the RSP when you pass away, the better from a tax perspective. Now, just to clarify, this is on the last person to pass. First person to pass, there's no taxes. It goes from spouse A to spouse B, tax-free rollover as long as there's a beneficiary listed. It's when the second person passes where this starts to create an issue. And there's a couple little special scenarios that fit in there if you've got a dependent child or an infirm child. But again, for all intents and purposes, let's really just assume it just happens this way. But it's a significant amount of taxes. Now, the interesting thing with Jen and I is that we've got a very detailed financial planning software that we use for our clients. And this is something that I may or may not have gone through this much detail with you. In the program that we have, it literally has hundreds of reports that we can prepare. But this is something that we're always keeping in the back of our mind. And in this case here, you can see that between 2020 and 2044, you can see how the tax bill changes and how it starts to come down. Usually one of the largest taxed assets in your estate is going to be a RRIF account or an RSP. The second one is probably going to be a recreational property or a rental property. So again, these are the kinds of things that we can start to look at. But in this case here, what we could do is we could take a look and say, well, in 2044, assuming you live to age 100 or whatever age that we've determined for you, if we know what that our estimated tax bill is going to be is $247,000, we can start making adjustments now to try to get that amount down. If we've gotten it down as low as possible and we can't get it down any lower, well, then maybe we take a look at a life insurance policy to pay that money. Or maybe you look at it and say, look, you know what, the kids are still getting a bunch of money. I'm okay paying the money to the government. So again, I think the important thing is to have this conversation for you to understand where it sits, and then you can make a good educated decision as to how you want to move forward. So we've talked about a lot of really interesting pieces here. And to me, I think the RRIF component is something that is really important. And a lot of people really don't understand it. I like the fact that you've signed into this webinar with us this evening, because it's given you a really good opportunity to start thinking about some of these things that are coming up down the road. Some of you might already be in this situation, and it's a great reminder. I have a lot of clients that look at this and say, Jamie, you know what, thanks for the invitation for the webinar, but you know, I've got you to help me through all of these things. And that's true. You know, I'm here to help all of you. But this is something that I think having a little bit of education, understanding how this process works a little bit, is just equally as powerful. Now, one of the things that Jen and I do is we are still taking on a couple of new clients into our practice every year. So as you're starting to talk to friends that are in a similar situation to you, and they're starting to talk about moving their RSPs to RRIFs, or how is this going to impact their old age security, and how is this going to look when, if they were to pass away, how do they structure it properly? You know what, please keep us in mind. Like I said, we are taking on a couple of new clients every year, and we'd love the opportunity to talk to somebody that you feel can really benefit from some of the planning that we're doing for you.